We have a really clear policy that we don't look at people's political beliefs or personal preferences, either when we onboard customers or if we take a decision to close their account. And I think that's the right answer.
We'll hear more from the Chief Executive of Lloyds Bank. Issues its half-year results. Plus, shares of Rolls-Royce surge as the aircraft engine maker raises its annual profits forecast. Good morning, this is Business Live with me, Ian King. Dame Alison Rose has stepped down as Chief Executive of NatWest Group after admitting of an inaccurate briefing to a journalist about the closure of Nigel Farage's bank account. The NatWest board had initially sought to defend the position of Dame Alison, who'd been in the job since November 2019. But it became clear last night that she'd lost the confidence of the government, which retained interesting story about the newspaper City AM. Tell us about that.
Yeah, that's right, Ian. Yesterday I reported that City AM was on the brink of calling in administrators, and that is still on the cards. But the interesting development this morning is that the newspaper is going to be bought by a very unexpected suitor, and that is THG, the London-listed online health and beauty retailer. Now, there is some commercial logic and industrial logic to this deal, I'm told, which is that THG sees City AM and its readership as prime candidates for some of its services, like its Ingenuity digital brand building platform. I'm told that THG has promised City AM's editorial team complete independence going forward, which is obviously an important thing for them and the credibility of the newspaper on an ongoing basis. Now, I understand that administrators from BDO will be appointed later on today with an immediate sale of City AM and its assets to THG, so a very unexpected buyer for another of Britain's media assets. Ian.
Great story. Thanks, Mark. There's a bit more detail coming through to us concerning the resignation of Dame Alison Rose as the NatWest Chief Executive. In the last few minutes, the Economic Secretary to the Treasury, Andrew Griffith, has been speaking on the matter and reacting to developments. Here's what he said.
Well, it's not the job of banks to tell us what to think or what political party we should support. The government's been extremely clear on this. In a democracy that relies upon freedom of expression, freedom of thought, and that isn't a legitimate thing for a bank to remove someone's access to a bank account, a really important building block of society today. And that's what I made clear in the meeting that I held with top bank bosses and the heads of building societies this morning.
Andrew Griffith plus dog there. Well, joining me now is Oliver Shah, the Associate Editor at the Sunday Times. Ollie, good to see you this morning. I mean, it looks as though it was a lack of political support for Dame Alison that did for her ultimately.
That's right. I mean, as Mark pointed out, the statement came out from the NatWest board around 5 p.m. Saying that she still had the full confidence of the non-executives. As we know, this is football manager territory, so that confidence can change depending on the circumstances. We then saw the first editions of papers, all pretty damning and carrying briefings from the government saying that Rishi Sunak, Jeremy Hunt and Andrew Griffith were unhappy with the situation. And clearly behind the scenes, that view was communicated to the board as well. And around 1:30 a.m. in an amazing U-turn, Alison Rose was dismissed, and Sir Howard Davies, the chairman, put out a statement saying it was a sad moment, but that she'd had to go.
Now, the Nigel Farage is now gunning for the NatWest board and Sir Howard Davies, the chairman. Do you think he's going to claim any more scalps?
He's not a natural authority on corporate governance, is he? But he's taken it upon himself to carry on the crusade. And I think, the non-executive board have emerged from this really badly throughout. There's a line in the Times leader today saying the truth has had to be extracted from NatWest at every turn, like a recalcitrant molar tooth. And the non-execs have given the execs very poor guidance throughout the whole crisis from the moment the first story broke in June, and they misread the mood and misjudged it completely in standing by Alison Rose yesterday afternoon while issuing a statement admitting that she'd inaccurately briefed the BBC about a client's financial details, which self-evidently she couldn't stay running a big bank, let alone one with a big taxpayer stake at that point.
Sum up her legacy, Ollie, for me, if you would, please. I mean, Charlie Nunn there in the extract we played was quite generous about what she's achieved.
Yeah, she took over in 2019, and Royal Bank of Scotland, as it was then, was still recovering from the misadventures of Sir Fred Goodwin in the financial crisis. Stephen Hester and then Ross McEwen had turned it around, and she inherited a bank that was recovering. She rebranded it NatWest to make a break with the legacy of the financial crisis. And she built her strategy around what she called being purpose-led, which critics always thought was quite waffly. But Lloyds Bank talks about helping Britain prosper, and it became very en vogue for big banks, especially those that had been bailed out by the government in the financial crisis, to make a real show of giving back and doing social good as well as making money. Clearly, to my mind, that purpose-led thing drifted into more dangerous territory of making social judgments and engaging on what we might call, in shorthand, culture war issues, where corporations should stay out and should stay apolitical. And I think the Farage exiting, as they call it, stems from people within the bank misunderstanding what their role should be and interpreting this purpose-led strategy as meaning they're there to act as moral arbiters.
Ollie, do you think this really marks a high watermark for corporates trying to make social comments of this kind? I mean, obviously we saw Unilever being pilloried by one of its shareholders for talking about a social purpose for mayonnaise, and now this.
Yeah, the worm has been turning for a while, hasn't it? We've had Unilever with, as you say, Terry Smith lambasting Alan Jobe, the now former CEO, for focusing on woke issues rather than making money. Disney in Florida obviously has really been whacked by Ron DeSantis for opposing his what's known as "Don't Say Gay" legislation. Now we've got this in the UK. I wrote a column at the weekend. The NatWest Alison Rose, Nigel Farage situation is a real warning to other boards about straying beyond what you know about and entering the realm of social judgments, which by their nature are very subjective. And I think businesses or business leaders should speak out in areas where they have expertise, where they can make a contribution to public debate, and they shouldn't be afraid of engaging in politics or engaging in broader social issues where they have a genuine reason for speaking out and real authority. What they shouldn't do is try and act like political parties or mini states where they take a view on every social issue around, from trans issues to Brexit. And they shouldn't wade into these issues which are nuanced and complicated and try and apply binary views for the purposes of, wanting a better phrase, virtue signalling.
All right, you're a man in demand, Olive, clearly today. Good to talk to you. Thank you.
Thank you, Ed.
Some other stories for you now. And higher interest rates across Europe have helped the Spanish banking giant Santander to report a pre-tax profit of €8.1 billion for the first 6 months of the year. That was up 2.2% on the same period last year, with the overall performance dragged down by higher provisions against loans it does not now expect to be fully repaid. Well, in the UK, where Santander is the third largest mortgage lender, the bank reported a pre-tax profit of £1.2 billion for the period. That was up 18% on the same period a year ago. Well, the bank set aside £148 million during the period in the UK to cover doubtful loans. Drug maker GSK said this morning that full-year results will be better than expected. The company now expects sales to grow by between 8 and 10% this year, compared with the previous forecast of 6 to 8%, with adjusted operating profit now expected to grow by 11 to 13%, up from 10 to 12%. Well, the news came as GSK reported sales of £14 billion for the first 6 months of the year, excluding COVID-19 treatments. That was up 13% on the same period a year ago and reflected strong demand in particular for HIV vaccines and for Shingrix, its top-selling shingles vaccine. Weaker iron ore prices have dragged profits at the mining giant Rio Tinto to their lowest level for 3 years. The fifth largest company in the FTSE 100 reported underlying earnings of $11.7 billion for the first 6 months of the year. That was down 25% on the same period a year ago and reflects the fact that prices achieved by Rio for its iron ore, mined from its giant operations at the Pilbara in northwestern Australia, were down 11% year on year. But the chief executive, Jakob Strausholm, insisted Rio was building momentum in its Pilbara business, which has just completed 5 consecutive quarters of year-on-year growth. The shares are slightly lower this morning. And shares of Lloyds Banking Group are also lower. They've slipped by 3% nearly this morning after its half-year profits came in slightly below expectations. Well, the bank, which owns the UK's biggest mortgage lender, Halifax, and which is also the biggest player in the UK current account market, reported a pre-tax profit of £3.87 billion for the first 6 months of the year. That was up 23% on the same period last year. But investors were worried that the net interest margin, which is the difference between what a bank charges borrowers and pays depositors from April to June this year, was lower than it was from January to March. Well, we've already heard from the chief executive, Charlie Munn. I've also been speaking to him about the bank's results this morning.
So we've had a very dynamic environment, as you know, and we've had challenges for a lot of our customers. On our mortgage business, we've had a few things that have happened in the first half. The first is actually we did a sale of some of our legacy mortgage positions, which we thought was the right thing, obviously, for those customers, for our shareholders, and we sold about £2.5–3 billion of our legacy mortgage positions. We've had very strong demand from our existing customers to want to remortgage with us, and that's been very important for us. And then on the open book, we've seen actually the whole market has been down a bit and has been very competitive, and so we've been supporting customers as they've been dealing with higher interest rates. So a really dynamic mortgage market. The focus for us has been those customers that are moving from a lower rate to a higher rate and making sure they've had the support they need.
Your net interest margin is up from 2.77% to 3.18%. There's obviously a live debate going on about pass-through of higher interest rates to savers. Do you worry that that increase in your net interest margin is going to reactivate that debate?
Well, actually, what we're seeing on Q2 versus Q1 is our net interest margin and net interest has fallen. It came down from 322 basis points in Q1 down to 314 basis points. And that's for two reasons. One is we've got very tight margins on our mortgage business. So our customers are dealing with much higher interest rates, and we're very aware of that. But actually, our mortgage margins are down to about 50 basis points. And historically, that's been more like 150 to 200 basis points. So customers are not getting that additional 100 to 150 basis points on mortgages. And then the second reason is just that discussion we're having on deposits and savings. A stronger pass-through around to our saving customers, and more customers looking at where they need their liquidity for everyday spending versus money they can put away to get a better rate of return. So that shift is what we guided to in the last 2 quarters. We expect that to continue to happen, and we're doing very proactive outreach to mortgage customers and to savers to make sure they've got their money in the right savings pot, or they are taking advantage of the right mortgage deal.
Now, impairments during the period rose from £377 million to £662 million. What sort of assessment about the business climate sits behind that provision?
Yeah, so the impairments progression has a bit of noise in it. We make adjustments under the accounting standards for our looking forward at the economic scenarios we have in place, and we actually increased our provisions given that we think the economy is going to be a bit slower and unemployment a bit higher in 2025 than we had previously assumed. If you strip that out, what we're seeing is actually very strong or really resilient customers and credit performance on our different businesses and different portfolios that we manage. We talk about the quality ratio, the AQR. It's about 30 basis points is what we've been guiding to, and actually that's been very consistent through this period. And when you look at our portfolios, mortgage arrears have remained very, very low and below pre-COVID levels. Our consumer lending businesses around cards and loans continue to perform, again, very strongly and are at levels of performance which are better than pre-COVID levels. And the same is true on our commercial and small business books. Where do we see the areas that customers are struggling? It's in a few areas. There's a few of our legacy mortgage customers who have a lower income and are struggling more with the increase in their payments around higher rates for mortgages. And we've got very targeted focus on those. It's a very small percentage of our customer base, but they're important. And in our business customers, the SME book, there's a few sectors that are showing and dealing with some very complex issues, specifically agriculture, transport and hospitality. And some of the businesses in those segments we're seeing their cash flows weaken, and we're really trying to put support to provide financial services support to them as well. And so those are the kind of target areas that we're focused on.
Well, equities in the Asia-Pacific region had a mixed session overnight. Mumbai, Sydney and Singapore were the only markets to finish higher. There were declines elsewhere across the region. Well, in Europe, stocks are all trading to the downside this morning. Actually, the IBEX in Madrid, more or less broken even there. Investors taking a cautious approach ahead of tonight's interest rate decision from the US Federal Reserve. Another interest rate rise expected there. There are an absolute stack of company results to digest this morning. Among the main talking points is the luxury goods group LVMH. Shares of France's biggest company are off by 4% in Paris as it pointed to a potential slowdown in growth. Well, here in London, the FTSE 100 is also in negative territory, off 0.5%. The oil and mining heavyweights are weighing on the index. There are some interesting features to mention, though. The leading blue chip gainer this morning is Rolls-Royce. It was ahead by 22% at one point this morning. There it is. It's still up at that sort of level. That's after a huge upward revision to its earnings forecast for the year. Also reporting today, British American Tobacco. Its shares up by 0.4% on its half-year results. To the downside, Lloyds and Rio Tinto both off on earnings updates, and so too is Reckitt Benckiser, the household goods giant, after it reported a drop in sales volumes. Outside the FTSE, Aston Martin Lagonda is ahead by 4%, also on a trading update. On the foreign exchange markets, well, it's all pretty quiet, to be honest, ahead of the Fed's decision this evening. The US dollar trading close to a 2-week high. Ahead of that decision, sterling up 0.1% right now against the greenback. As for the oil price, well, that hit another 3-month high overnight amid talk of supply shortages amid a coming Chinese economic stimulus package. A barrel of Brent crude will currently set you back $82.82 a barrel. That is down nearly 1% on the session. Joining me now is Victoria Scholar, Head of Investment at Interactive Investor. Victoria, good to see you this morning. Talk to me about Rolls-Royce. What an absolutely stunning share price move.
Absolutely, like you say, up by more than 21% after it raised its full year profit forecast by 45%. It's now looking at profit of between 1.2 billion and 1.4 billion for the year, which was sharply higher than its previous guidance for around 800 million to a billion. But this just adds to an already incredible run for the stock so far this year. And things could really be getting much better for CEO Tufan Ergin-Bilek, because he started at the start of the year, and it really looks as though his transformation plan across divisions is bearing fruit. We've seen incredible improvements in terms of its operational performance. It's also benefited from the post-COVID revival in flying hours, and then there's been that boost to defence spending on the back of the war in Ukraine. And the CEO commented back in May that this turnaround plan has been moving at pace, which marks a major sea change from what we've seen from Rolls-Royce for many, many years. The stock peaked back in 2014 and has largely been under pressure ever since, until COVID and the challenges there. Now it's the best performing stock on the FTSE 100 over the last 6 months, and it's the second best performer over the past year. So real turnaround and a real boost for shareholders.
And it's obviously a hugely busy day, Victoria, for company results. I mean, Reckitt sort of slightly coming under the radar this morning. It's an interesting story, though. I mean, it looks like some of their customers have been pushing back against price increases.
Yeah, that's right. I think that price increases has been a key part of its strategy, despite the criticisms this year among the consumer goods giants and the supermarkets of greedflation and profiteering, passing on those additional cost pressures to consumers in terms of higher prices. And of course, as a vendor of consumer goods, things like Dettol and other products we all need so much, they do have that pricing power. But there is, of course, the risk that consumers trade down to those unbranded supermarket alternatives amid the cost of living crisis. But what we've seen today is that its like-for-like revenue actually beat expectations. There was strength in health and hygiene, while nutrition has struggled. But the shares are under a bit of pressure. We did see that Unilever-driven bounce yesterday, so perhaps some of this good news was already priced into the stock on Tuesday. Yeah, we'll have to wait and see what happens next. But in terms of its performance versus the FTSE 100, it's been okay. It's been pretty much flat now after we factor in those declines today. So it is a slight underperformer versus the blue chip index.
OK, Victoria, got to leave it there, I'm afraid. Good to talk to you today. Thank you. Bit of breaking news to bring you. We've just heard from the Rail Delivery Group, which has just said that a consultation on ticket office closures, which was due to end today, has been extended to the 1st of September. Obviously, the rail union is very unhappy about that proposal. More to come on that, I'm sure, as the day goes on. In the meantime, still to come here on Business Live, we'll get more reaction from the Treasury to the resignation of Dame Alison Rose, the NatWest CEO. Stay with us.
Bluntly, this is the new normal. We need to learn to adapt to these higher temperatures. But what's really critical, and what the World Weather Attribution scientists have shown us this morning, is that although this is going to get more frequent, this sort of intense and very hot heat wave, actually it will keep getting worse as we keep emitting greenhouse gases. So if we reduce our greenhouse gases very rapidly, then we can avoid this getting very, very much worse, and to the point where it's much harder to adapt to. So a lot of people say, well, look at 1976, you know, one of the hottest summers we've ever experienced in the UK. But the difference about 1976, or when your viewer was going on holiday in the 80s, is that that was really unusual then. Back in 1976, the temperatures in the UK were a hotspot, and the rest of the world was quite normal. But even then, we saw excess deaths rise by about 30%. It doesn't heat equally, because already some parts of the planet are already hotter than other parts of the planet. Some parts react differently. For example, in the Arctic, actually it's warming 3 to 4 times faster than other parts of the world. And in some of that is because of the melting ice. That melting ice, that melting snow, that would normally reflect more of the heat. And so as there is more dark ocean where there is not ice, it absorbs more heat. And so the region heats faster. So different parts of the planet heat at different rate. Sea temperatures are frighteningly high this year. They
Particularly in the Mediterranean.
Particularly around the Mediterranean and around the UK. We had a marine heatwave around the waters of the UK just a few months ago, 4 to 5 degrees higher than normal temperatures, I think. That's incredibly dangerous for the wildlife in the oceans, but it also, hotter sea temperatures add to the heat we've already put into the atmosphere and add to the heat that we're experiencing.
Slightly Emirates, slight better. Fly Emirates, fly better.
Thank you.
Welcome back. More now on the resignation of Dame Alison Rose, the NatWest Chief Executive. As we've been reporting this morning, the Treasury has had banking executives in to talk about this issue of debanking. Our business correspondent Paul Kelso has a readout on that meeting. Paul.
Yeah, I've been speaking to Andrew Griffiths, the Treasury Secretary, who convened that meeting remotely with 19 Bank and Building Society bosses this morning, or certainly from leadership. No, Alison Rose, as far as we know, in which he said he reiterated the government's position, which is that someone's political views should never be used as a reason for removing a bank account and preserving freedom of expression. The readout from the Treasury says that all the banks there agreed that this has been, the NatWest Farage affair has been damaging for the industry, and agreed to make sure that they react to government policy, which is going to change, which will give people more. The banks will have to give people reasons for why accounts are being terminated, and a longer period to object to any termination. It should be said the government's reservations about Alison Rose didn't exist last week when she was appointed to the Prime Minister's Business Council. She's lost that post already this morning. There will be a commercial impact, one would imagine, to NatWest. She was delivered the largest profits the bank has had since the crash. It appears in this case ministers have been willing to put political principle ahead of any commercial impact on what is a large taxpayer's stake in an enormous bank.
OK, thanks, Paul. That's it from me. I'm back with our afternoon edition at 4:30 this afternoon. Hope very much to see you then. In the meantime, do stay tuned. Up after this short break, it's Jane Secker. See you later. Cheerio.